In 1993, Warren Buffett paid $433 million for a shoe company that would cost him $18 billion. The Oracle of Omaha, the most disciplined investor in history. The man who built a fortune on patience and careful analysis. He made a mistake so significant, he called it the most gruesome decision of his entire career. And here's what makes it worse. He broke his own golden rule to make it happen. For decades, Buffett had insisted on one principle: never pay with Berkshire stock unless you're getting equal value in return. He'd said it 1,000 times. Then he violated it for a shoe company. In Maine, by 2001, Dexter Shoe was valueless. The factories closed, the business collapsed. But those shares he gave away, today they're worth $18 billion. So how does the world's greatest investor misjudge a simple shoe business so badly? And why did he use stock when he'd always insisted on cash? The answer involves not one mistake, but two psychological traps working together. And the second one made the first one 40 times worse. In the next 16 minutes, we'll break down exactly what happened, reveal the cognitive biases that blinded even Warren Buffett, and show you how to recognize these same patterns in your own portfolio. Because if it can happen to him, it can happen to anyone. Picture this. It's September 1993. Warren Buffett is 63 years old and at the absolute peak of his powers. Berkshire Hathaway stock is trading at $16,675 per share. His reputation is untouchable, and he's just found what looks like a perfect acquisition. Dexter Shoe Company, based in Maine, manufacturing high-quality men's and women's shoes in factories in Maine and Puerto Rico, producing over 7,000 pairs a day, generating more than $40 million a year in pre-tax earnings. The numbers looked spectacular. High return on capital, experienced management, a strong brand, everything Buffett loved in a business. But here's the thing, Buffett wasn't guessing. He had proof this strategy worked. 2 years earlier, in 1991, he'd acquired another shoe company called H.H. Brown. That deal had been a home run. The company was profitable, well-managed, and thriving. Buffett had written about it glowingly in his shareholder letters. He understood the shoe business. Or so he thought. When Frank Rooney, the CEO of H.H. Brown, brought Dexter to Buffett's attention, the decision seemed obvious. It seemed like a no-brainer. Another quality shoe manufacturer, strong fundamentals, a chance to build on his success. Harold Alfond, Dexter's founder, was ready to sell. The price was agreed, $433 million. And then Buffett made the decision that would haunt him for decades. Instead of paying cash, he used Berkshire Hathaway stock, 25,203 Class A shares. At the time, this represented about 1.6% of all Berkshire shares outstanding. Pause for a moment and consider that. 1.6% of the entire company. For a shoe manufacturer, this wasn't small money. This was a bet he'd live with for decades. This was extremely rare for Buffett. He treated Berkshire stock like gold. He'd repeatedly told investors, only use stock when you're certain you're getting equal or greater value in return. But he was certain. In his 1993 letter to shareholders, he wrote glowing praise. Dexter is one of the best managed companies Charlie and I have seen in our business lifetimes. He called it a business jewel. He said the acquisition was a sound decision. He projected that Dexter, combined with H.H. Brown, would generate more than $85 million in profits in 1994. He was so confident. He even joked about it. In his annual letter, he wrote, I sing there's no business like shoe business as I drive to work. But there was something Buffett saw and dismissed. In that same 1993 letter, he acknowledged the elephant in the room. Cheap imported shoes from low-wage countries were flooding the American market. Foreign competition was real. He knew it, But he believed Dexter was different. He wrote that someone forgot to tell Dexter's managers and workers about this threat because their factory was highly competitive against all comers. He saw the macro trend. He just didn't think it applied to this company. What Buffett couldn't see, or wouldn't see, was already destroying American manufacturing. Within 2 years, everything would change. And by the time he realized it, it was too late to undo the damage. 1994 came in exactly as predicted. The shoe division hit $85 million in pre-tax profits. Right on target. Buffett's confidence seemed validated. In his annual letter, he praised the shoe business. Everything looked perfect. But the numbers masked a darker reality. By 1995, the first cracks appeared. Dexter's sales growth slowed. Chinese manufacturers were producing shoes at a fraction of the cost, 40% cheaper, sometimes 50%, with quality that was improving rapidly. American consumers didn't care about made in Maine if they could get similar shoes for half the price at Walmart. Dexter's management tried to compete. They improved efficiency. They streamlined operations. But you can't streamline your way out of a labor cost disadvantage that fundamental. By 1996, the decline accelerated. Other American shoe manufacturers were closing plants, moving production overseas, or going out of business entirely. The writing was on the wall. Dexter's revenues kept falling, month after month, quarter after quarter. The trend was undeniable. Profit margins compressed. The durable competitive advantage Buffett had been so certain about was evaporating in real time. And Buffett? He rationalized it. Temporary market conditions. A cyclical downturn. Quality would eventually win. Premium products would find their market. 3 years after the acquisition, the situation was getting dire. By 1999, the numbers told a brutal story. 93% of all shoes sold in America came from abroad. Dexter's competitive advantage hadn't just weakened. It had vanished completely. Berkshire's entire shoe division profits had collapsed from $85 million to just $17 million. 2/3 gone. But Buffett wasn't ready to quit. And here's where the psychology gets darker. He'd already seen this pattern destroy other American manufacturers. He'd watched competitors close their doors, one by one. But he kept believing Dexter would be different. That somehow, his analysis had uncovered something everyone else missed. In his 1999 shareholder letter, Buffett finally admitted what he'd been avoiding. It has become extremely difficult for domestic producers to compete effectively. In 1999, approximately 93% of the 1.3 billion pairs of shoes purchased in this country came from abroad, where extremely low-cost labor is the rule. Brown had already started sourcing shoes internationally just to survive. But Dexter? Dexter was bleeding. By 2000, Buffett could no longer avoid reality. In his annual letter, he wrote the words that must have hurt to type. "I clearly made a mistake in paying what I did for Dexter." Then he added, "I compounded that mistake in a huge way by using Berkshire shares in payment." The business he'd called a jewel was now valueless. The $433 million investment had been completely wiped out. Every dollar gone. But admitting it and acting on it turned out to be two different things. By now, you're probably wondering, why didn't he just shut it down immediately? This is where the psychology gets really interesting. Because what happened next made the mistake even more expensive. Instead of closing Dexter in 2000, Buffett did something that would make the disaster even worse. He kept trying. He kept hoping. He kept throwing resources at a company that was already dead. And the losses kept mounting. He handed the struggling company to the management team at H.H. Brown. Maybe they could turn it around. Maybe there was still a way to salvage something. It was a classic sunk cost decision. He'd already lost $433 million. He'd already admitted the mistake publicly. But the psychological pain of giving up completely, of admitting total defeat, was too much. So he tried to fix it. 2001 was a disaster. Berkshire's entire shoe division finished $46 million in the red. In his shareholder letter, Buffett wrote that they were swamped by losses at Dexter. The company was dying. Hundreds of workers in Maine lost their jobs. People who'd made shoes their entire lives. Gone. Factories closed. The brand that Buffett had praised as one of the best managed companies we'd ever seen was being absorbed into H.H. Brown just to stop the hemorrhaging. Manufacturing ceased in 2001, but then something unexpected happened. In 2002, the shoe division clawed back to a $24 million profit, and Buffett, grasping for any positive sign, wrote, "The Dexter operation has been turned around." It hadn't been. The brief rebound was temporary. Dexter was finished. Looking back, those extra 2 years, from 2000 to 2002, were pure sunk cost fallacy, throwing good money and management time after bad, hoping to salvage something from a decision that was fundamentally doomed. By 2007, Buffett was ready to fully confront what had happened. In that year's shareholder letter, he wrote the most complete autopsy of his mistake. What I had assessed as durable competitive advantage vanished within a few years. But that's just the beginning. By using Berkshire stock, I compounded this error hugely. That move made the cost to Berkshire shareholders not $400 million, but rather $3.5 billion. At the time, those 25,203 shares were worth $3.5 billion. Today, January 2026, with Berkshire Class A shares trading at $747,860, those shares are worth $18.85 billion. He concluded, "To date, Dexter is the worst deal that I've made, but I'll make more mistakes in the future. You can bet on that." And then, with the dark humor that Buffett is known for, he quoted a line from a Bobby Bear country song. "I've never gone to bed with an ugly woman, but I've sure woke up with a few." Even in catastrophic failure, Buffett could laugh at himself. That might be the most important lesson of all. So what was really happening here? How does Warren Buffett, a man who built a $750 billion company on discipline, skepticism, and emotional control, walk straight into a trap that destroys $18 billion in shareholder value? Buffett himself would later dissect exactly what went wrong. And when you understand the psychology behind it, you'll see why even the smartest investors, maybe especially the smartest investors, fall into these traps. Because it wasn't just one cognitive bias. It was two, working together, amplifying each other. The first bias, overconfidence. The second bias, sunk cost fallacy. Let's break them down. Overconfidence bias is when past success tricks you into thinking you can't be wrong. You've succeeded before, so your brain says, "I've got this figured out." You stop asking the hard questions. You stop looking for problems. It's the investor's version of a surgeon saying, "I've done 100 of these operations right before the one that goes terribly wrong." Or the pilot who's flown into that airport 1,000 times and gets complacent on landing number 1001. Experience creates confidence, but confidence can become overconfidence, and overconfidence creates blind spots. Here's how it showed up in Buffett's decision. First, false pattern recognition. In 1991, he'd bought H.H. Brown. That acquisition was a home run. So when Dexter came along 2 years later, his brain said, "I know this pattern. I understand shoe companies. This is my circle of competence." But Dexter wasn't H.H. Brown. The industry was changing underneath him. The competitive landscape was shifting. Each company is different, even in the same sector. This is the trap. Experience should make you better, but sometimes it just makes you blind. Second, selective attention. Buffett acknowledged the China import threat in his 1993 letter. He saw it, but he immediately dismissed it. He wrote that Dexter's factory was highly competitive against all comers. He saw what he wanted to see: strong management, good margins, and quality product. And he ignored the macro trend that was about to destroy every domestic shoe manufacturer. Third, breaking his own rules. Buffett had one golden rule for acquisitions: never pay with Berkshire stock unless you're absolutely certain you're getting equal value. He broke that rule for Dexter. Why? Because he was so confident in his analysis that he believed Dexter was worth 1.6% of Berkshire Hathaway. That's how overconfidence works. It makes you override your own risk management systems, because this time is different. But the overconfidence was just the first mistake. The second mistake, the sunk cost fallacy, made it so much worse. The sunk cost fallacy is when you continue investing in something that's failing. You keep going simply because you've already invested so much. Your brain says, "I've already put in X dollars. I can't quit now." That would mean all that money was wasted, even when quitting is obviously the smartest move. It's like sitting through a terrible movie just because you paid $15 for the ticket. The $15 is gone either way. But walking out feels like admitting defeat, so you stay and waste 2 more hours. Or staying in a failing business for years, because I've already invested so much time and money. I can't give up now. The money is gone. The rational decision is to cut your losses and move on. But the emotional pain of admitting total failure is too intense. So you keep going. For investors in their 50s and beyond, this pattern is especially dangerous. You don't have decades to recover from a mistake you refuse to admit. Here's how it showed up after Buffett realized Dexter was failing. In his 2000 shareholder letter, he publicly admitted the mistake. He wrote, "I clearly made a mistake in paying what I did for Dexter. I compounded that mistake in a huge way by using Berkshire shares." That's complete honesty. Total transparency. Exactly what you'd expect from Buffett. But then, he didn't close Dexter immediately. Instead, he assigned the HH, Brown management team, to try to turn it around. Maybe they could fix it. Maybe there was still hope. He'd already lost $433 million. But maybe, just maybe, he could salvage something. Classic sunk cost thinking. In 2001, the shoe division lost $46 million, swamped by losses at Dexter. Workers lost their jobs. Factories closed. The business was clearly terminal. But in 2002, there was a brief profit rebound to $24 million. And Buffett wrote, "The Dexter operation has been turned around." He was looking for any sign that his continued investment of time, energy, and management resources was justified. Any evidence that he hadn't completely wasted years trying to save an unsavable business. Those extra 2 years, 2000 to 2002, were pure sunk cost fallacy. Throwing good money after bad, because the alternative was admitting complete and total defeat. So why did even Warren Buffett fall for these traps? 3 reasons. First, success breeds blindness. By 1993, Buffett had 30 years of incredible success. He'd earned the right to be confident. But that confidence became overconfidence. Success can make you stop questioning yourself. Second, availability heuristic. The H.H. Brown success was recent and vivid. It was right there in his mind. Pattern matching is one of the most powerful tools in investing, but sometimes patterns lie. Industries change. What worked before doesn't always work again. Third, public commitment. Buffett had praised Dexter in his letters. He'd used precious Berkshire stock. His reputation was on the line. Backing out immediately would mean public embarrassment on a massive scale. The psychological cost of admitting error immediately was too high. So he tried to salvage it. Human nature, even in the world's greatest investor. The final tally? Business value, 0. Failed completely by 2001. Opportunity cost, 25,203 shares, times $747,860 per share. As of January 2026, $18.85 billion. $18.85 billion. In his own words from the 2007 shareholder letter, in essence, I gave away 1.6% of a wonderful business, one now valued at $220 billion, to buy a valueless business. To date, Dexter is the worst deal that I've made. And then, that country song quote, I've never gone to bed with an ugly woman, but I've sure woke up with a few. It's crude. It's funny. And it's painfully honest. Even in catastrophic failure, Buffett could laugh at himself. That might be the most important lesson of all. So what can investors in their 50s, 60s, and 70s learn from Buffett's $18 billion lesson? There are 3 patterns here worth recognizing in your own portfolio. Pattern 1. Past success, creating future blind spots. Buffett's H. Brown success made him overconfident about Dexter. He thought he understood the shoe business. But each company is different, and industries change. Ask yourself, when has your past success in one area made you too confident in a related but different investment? Are you holding something now because I've always been good at spotting these opportunities? Pattern 2. Ignoring macro trends. Buffett saw the China import data. 93% of shoes sold in America were imports. But he believed Dexter was the exception. Quality and management would protect it. Ask yourself, are you holding investments where you're ignoring industry-wide shifts because you believe your specific company is exceptional? Are there obvious headwinds you're rationalizing away? Pattern 3. The sunk cost whisper. After admitting the Dexter mistake in 2000, Buffett still tried to fix it for 2 more years. The psychological pain of total failure was too much. Ask yourself, do you have investments you're holding because of what you paid for them, not what they're worth today? Are you staying in something because I've already lost so much, I can't sell now? 3 more questions to sit with. 1. When you research an investment, are you looking for reasons you're right or reasons you might be wrong? Confirmation bias makes us seek validation, not truth. 2. Have you ever broken your own investing rules because you were really confident about a specific opportunity? Rule breaking is often the first sign of overconfidence. 3. Do you have investments where you're waiting for them to get back to even before you sell? That's your purchase price talking, not rational analysis. These aren't comfortable questions, but they're the ones that matter. For investors in their 50s, 60s, and 70s, this matters more than ever. Warren Buffett was 63 in 1993. He had decades to recover from the Dexter mistake. He could afford to lose $18 billion in opportunity cost and still be fine. But for most investors approaching or in retirement, time is the asset you cannot replace. An $18 billion error scaled to your portfolio could mean the difference between financial security and crisis. The Dexter story teaches that even at the peak of success, even with decades of experience, cognitive biases don't discriminate. If Buffett, with unlimited resources, access to the best information, and Charlie Munger, as a thinking partner, could fall into these traps, any of us can. The difference is, Buffett admitted it, learned from it, and shared it publicly so others could learn too. That's the mark of true wisdom, not avoiding mistakes, but learning from them and helping others avoid the same pain. This is educational analysis of historical investment decisions, not financial advice. Every investor's situation is unique. Before making any investment decisions, always consult with a licensed financial advisor who understands your specific financial situation, goals, and risk tolerance. Buffett's Dexter mistake taught him to be more skeptical of his own judgment, especially in industries facing disruption. He never made that exact mistake again. But another legendary investor didn't learn the lesson. In the next video, we'll look at how Icahn lost over $4 billion in a nearly identical psychological trap. Except he saw it coming and still couldn't stop himself. The story involves Netflix, Blockbuster, and one of the most painful I told you so moments in investing history. A masterclass in how even the most aggressive, battle-tested investors can fall victim to the very biases they think they've conquered.